Welcome back to the Deep Dive. Our mission today is to really unpack a huge, and I mean huge, unaddressed category within the online sports betting industry.
Right. We're looking at a market that's, over $100 billion in the US alone, and it's still growing.
Still growing, and yet the product itself feels, I don't know, a bit stale. It's very solitary, very transactional.
It really is. It's a mature market, but frankly, with a very immature product strategy. You look at the Giants, your FanDuels, your DraftKings, and their model is just, it's heavy on these expensive promotions to get you in the door.
Because the churn is so high.
Exactly. The engagement is disposable. It's built for one person betting alone, but that's not how people experience sports. It's a group activity,
Which brings us, I think, to the central question for this entire deep dive.
Let's hear it.
Why hasn't anyone built a fantasy league of real money sports betting yet? And, maybe more importantly, why might a company like Parlaymint be the first one to actually crack that code?
That gap you just mentioned, that's what we're here to analyze. It's this massive disconnect between how the product is built and how users actually behave.
The incumbents seem to have just ignored it.
Well, because their whole architecture is locked into that single-player cash register model. So the key here, what some of our sources are calling the atomic shift, is moving from that lonely bet slip to a cooperative group challenge.
And the engine for that shift is a patented mechanic called only losers pay.
That's the wedge. It's what takes all that energy from your group chat and moves it into a clean, regulated, real money product. And to see why it's so strategic, we really have to get into the mechanics of it.
Okay, let's do that. Unpack the system for us. When you say only losers pay, what does that actually mean? How does it rewire a parlay, which is, traditionally a very punishing bet?
Okay, so let's walk through the money flow step by step. First, every single player in the group contributes just one pick, not a whole slip, just one leg of the parlay.
One pick each. Simple?
Simple. And everyone pays the same buy-in up front. That money then goes into a secure internal escrow. They call it the held funds.
So it's pooled, but it's not immediately staked against the house. It's held.
Correct. Now let's play out the good scenario. Scenario one. Everyone wins. All the picks hit.
The dream parlay.
The dream. In that case, Parlaymint pays out the full sportsbook equivalent odds for every single winning leg. That's pure house risk, just like a traditional sportsbook.
Okay, but the really interesting part, the part where group bets always fall apart, is the loss scenario.
This is where the magic is, and it's what the patent protects. If any single pick loses, the whole parlay crashes.
Right, standard parlay rules.
But here's the twist. The players whose picks actually won, their individual legs were correct, they get their full buy-in back instantly. Their stake is just refunded.
Wow. Okay, so where does the money for the refunds and the operator's cut come from?
It's funded only by the stakes of the players whose picks lost. Only the losers pay.
That's a profound shift. Because in any normal group bet, if your friend makes a bad pick, they've just lost your money.
Yeah.
And that creates so much friction.
We've all been there. The guy who picked the last leg goes completely silent in the group chat. This model it removes that sting completely.
So that's the psychological barrier you're talking about. It takes away the anxiety of, I don't want to be the one who makes my friends lose their money.
Exactly. Winners are always made whole. They essentially got a free roll. And that fundamentally changes the willingness of a group to play again and again, and even to collaborate on picks. It moves from competition to cooperation.
It's an incentive engine. And you mentioned it's defensible. This isn't just a marketing slogan.
Not at all. It's covered by U.S. and Canadian patents.
Right.
We're talking U.S. 11308764B1. The core logic, the shared payout, the single pick contribution, and that specific loser-funded refund structure is all locked down.
So the IP is the first layer of the moat.
The first layer, yeah. But a patent just protects an idea. The behavioral data is what proves it works. And that's where we need to connect the social dynamic to the long-term economics, because group play isn't just a feature. It's the atomic unit of retention.
So what are you seeing in the early user data? What's the difference between these organized groups and just, random public players? The numbers have to back this up.
Oh, they do. The signals are incredibly clear. If you look at retention, for example, group parlays fill up way more reliably, they retain users at a dramatically higher rate, and they generate more rounds per user.
They form what the sources call persistent betting crews.
That's the term.
Yeah.
And the act of forming a group is the single strongest leading indicator for long-term retention we've seen.
That's a powerful social lock-in. You're not just betting anymore, you're part of a crew.
Precisely. And that social trust actually translates into a financial multiplier. The data shows group players wager meaningfully higher buy-ins. The handle quality is just better.
And what about friction? Because we know that's a huge killer for retention in this space.
Yeah, time to fill is the key metric here. The data shows that when small groups fill their parlays fast, say under 5 minutes, the rejoin behavior is much, much stronger.
And they start driving their own growth.
That's the organic virality loop. Users aren't just sharing winning slips to brag, they're sharing functionally. Hey, one spot left, or your friend just joined. It's self-propelling.
Let's connect that back to the incumbents. We know parlays are already the cash cow. I'm looking at some Colorado data here. Parlays are about 24% of the handle, but drive a way bigger share of the revenue. The implied hold is something like 13.2%.
Right, so they love multi-leg risk,
Right.
But Parlaymint's model gives them a superior cost basis. A traditional book's hold is, around 7.4% on average in a market like Colorado?
Yeah, that's the cumulative market hold.
So Parlaymint's economics also scale with handle, but that loser-funded pool covers a huge chunk of their payout exposure. It structurally lowers their net liability.
So if I'm getting this right, a traditional book has high revenue, but also really high unpredictable risk on these parlays.
Exactly.
Parlaymint is trading some of that crazy upside for a more bounded, predictable, and efficient profit model.
That is the structural advantage, yes. And it's a model built on user trust, not one that feels punitive.
This all sounds great. It's a fantastic model, but it begs the big question. Why can't FanDuel or DraftKings, with their billions of dollars and huge user bases, just do this? Why can't they copy it and own the category overnight?
And that right there is the most critical insight for any investor listening. The short answer is architectural debt.
Architectural debt.
FD and DK are at their core single-player companies. Their entire tech stack, every line of code is built for one user, one bet slip, one account, and one simple binary outcome, win or lose.
So it's not as simple as just adding a chat window to the app.
Not even close. To do this, you need multi-user bet objects, you need multi-wallet held funds, you need conditional settlement rules where my payout depends on your outcome, and you need a conditional refund mechanism.
Which means you're tearing into the absolute core of their regulated systems. KYC, AML, the risk engine, everything.
Everything. This isn't a feature, it's a complete core system rewrite. Our sources estimate that for an incumbent to build this, get it tested, get it approved by regulators in every jurisdiction, you're looking at 18 to 36 months of work. Minimum.
And that's assuming they even want to.
Which they don't. That's the risk engine conflict. Their profitability, their bread and butter is built on high variance, same game parlays. Those are massive cash cows.
So if they introduce Parlaymint's model, which is lower variance, more bounded,
they directly cannibalize their most profitable products.
Yeah.
The incentive structure for them is to protect their existing funnels, not to invent a whole new category that undermines them.
And that explains why their social features feel so tacked on. They're all window dressing.
Exactly. Sharing a bet slip, having a leaderboard that's social around the bet, not inside the mechanic. They don't have the patented logic. They don't have the retention loops. And that leaves this massive defensible white space for a new player to just own the category.
Okay, let's look beyond the product for a second. There was a huge regulatory ruling out of Ontario in November 2025. That seems like a pretty big tailwind for a model like this.
A massive tailwind. The Court of Appeal basically confirmed that a province can run an online gaming scheme with players from outside Canada as long as the province itself conducts and manages it.
So for a pooled product that thrives on having more players,
it's a game changer. It breaks down the borders and opens the door to much, much greater liquidity. The network effects can scale across jurisdictions, which is essential.
And the company's going down the fully regulated path.
They have to. They're starting in Colorado. They have an LOI with Saratoga Casino Blackhawk. And what's interesting is that the model itself, with the held funds and the transparent settlements, is actually simpler for regulators to understand. It might even be seen as a lower risk than traditional parlays.
So the very thing that makes it socially sticky also makes it more compliant.
It's a virtuous cycle.
The patent is strong, the structure is strong. But what's the long-term moat here, beyond the IP?
At the end of the day, the moat is the behavioral engine. It's the social graph. Once those persistent betting crews are formed, the switching costs are incredibly high.
Yeah.
You can't just pay to acquire a friend group.
Right, you can't just offer a bonus to break up a trusted group.
You can't. And then you layer on the future roadmap, using AI to suggest groups, to recommend picks. You're building a data moat based on collaborative behavior, which is something the incumbents aren't even tracking. And finally, you have the option to B2B license the engine. That's a powerful defensive position.
So let's bring this all together. For any strategic partner, any operator listening right now, the thesis is that Parlaymint can own the sports betting with friends category. It can shift the battleground from this endless money-burning promo war
to a fight over product stickiness. They offer the fastest, lowest risk path for an incumbent to plug this massive hole in their offering without having to, tear down their own house to do it.
That structural reality really is the whole opportunity, isn't it? A patented engine that solves the biggest pain point in the most profitable part of the market.
It is. So the fundamental question for any investor or strategic partner out there is really this. Do you spend, say, $30 million in 2 years on a risky internal rewrite with no guarantee of success? Or do you acquire the category leader that already has a patent and proven user behavior?
And if the true value of a company is really its ability to acquire and retain users efficiently, then you have to think that the patent protecting that behavioral engine, that social graph, it might ultimately be worth more than the handle it generates today.
It's a build versus buy question, and the clock is ticking.
You have to wonder how long it will take for an incumbent to decide that acquiring a category is just cheaper, faster, and a whole lot less risky than trying to build it from scratch.
That choice is going to define the next 5 years in this market.
And that's our deep dive for today. We hope you feel well informed.